Yes, we are meeting the target which we set for this year, and as we are approaching closely the end of the year, we are expecting almost 20% rise in this year compared to the previous year, in top line as well as in bottom line both. So it is according to our projection and according to the target that we set.
Right. And any update on the Singapore case? Where do we stand now, and any impact coming from there?
In Singapore court, there are two parallel channels where the court proceedings are going on today. One is Singapore Supreme Court, where appeal is going to get heard, and the dates which are indicated ranging between April 1st to April 12th. So any of these dates, we will have final hearing for the appeal of the order of the Singapore International Court, which was awarded on July 3rd, 2018, which is going to take place. The second channel, which is going on as court proceedings in Singapore International Court, where we see that the valuation is continuing, valuation timelines are fixed, and valuation criteria has already been announced. So valuation process is going on as per the schedule and as per the court's given stipulated dates and timelines, which we see that by the middle of the year, we might be near to the close of that process also. So we are approaching in Singapore for both the courts in a final phase of proceedings today.
Right. So Singapore International Court, the case is pretty much in the final stage. But Manish, if you could just help us understand, what is the current portfolio mix looking like? And do you see a rejig happening? And if yes, where do we see it by the end of FY20?
Our current quarter is going better than the last quarter. But if you look at and compare year-on-year basis, we have almost 40% sales and 40% of our total revenue coming from dyes and about 60% revenue coming from intermediates. We see some improvements in intermediate prices this quarter, and by the time we close the year, we will have this entire year average out to be a little bit better margin point of view compared to the previous year as a whole. We see that the next 2-3 years, we should have at least 25 to 30% growth based on the current projects and the expansion plans which are in pipeline and are about to get completed in the coming financial year 2019-20. So looking at the upcoming projects, looking at what we see as the margins which we have earned in this year, which we see continuing in the next year from the current year onwards, and overall prospects seem to be consistent in the next year and year after.
So since you're looking for debottlenecking, that's definitely going to increase volume. So from the volume market share perspective, how's the export outlook looking to you, and any expansion plans in the geographies, in the America region or the domestic market? How are those looking?
Currently, we are having a stable network in various countries where Kiri has been active selling products. We are trying to add, using the same channel, more and more products, but existing sales and distribution network is equipped enough, and we are trying to penetrate in certain geographical areas where we are less present today. To give you an example, certain parts of South America where we are having comparatively lower presence, we would try to improve our presence there. Similarly, in Asia, our footprint is strong, but we are still trying to increase from where we are. Domestic market in India, we have been focusing less till now. But recently, for the last 2 quarters, we have increased our dye sales focus in domestic market in India, because India, we comparatively have much lesser market share compared to other parts of the world. So at home ground, we may try to increase our market share, and we may try to reach out to many customers where we have not been catering till now.
Right. So South America will be in focus. Increase in market share with regards to the domestic markets is something that you're looking at. But Manish, debt reduction, a significant amount has been reduced in the last 3 years, which is really positive for the company. Right now, what is the cash on the book looking like? And is there any major capex plan in the near term that you're looking at?
The current capex plan, which we have been investing in for the last 2 years, are going to continue, and we are going to complete our multi-purpose intermediate facility in this year, which is 1920, and which are having two major buildings in our existing campus. That is what we are going to complete today, and in this current year, that's what I mean. That would provide company growth for the next 3 years, because those plants to come to full stream, to having a decent capacity utilization of 80-90% is also going to take some time. So that would provide company a significant growth, what I indicated, over the period of next 2 to 3 years. So those are the capex plan which are in progress. There are no new capex plan that we are opening up currently, and our focus would be to complete the existing capex that we are investing for.
Well, that's the word on capex. But Manish, what's the outlook on FY20, and what are the growth drivers you're looking towards?
2020, we are looking at 25 to 30% growth on a top line, and similar bottom line from percentage point of view where we are today. 2020, we are going to add at least few more products and product ranges to expand our product basket. And we are also 2020 targeting to have a little bit more export market share from where we are today. So combination of all three would give us the targeted and projected growth in 2020.
Right, so 25 to 30% growth on top line by 2020 is what the management is indicating. Very lastly, Manish, so is it safe to say that margins would be a bit under pressure on the ramp up of newer facilities?
Because we are trying to have better profitability in the new specialty products that we are introducing. So that would allow us some room on the percentage of profits from the sales. For example, EBITDA percentage would be better, but capacity utilization on new plants would be lower. That's why, as if we maintain the existing EBITDA levels on our overall growth plans, it would be, even though the new facilities would be starting, it would be achievable for the company, and that is what our projection is. And we are confident that we would be able to maintain the margin levels going forward. But when the capacity utilizations are achieved at a higher level in subsequent years, our margins might improve. Second important factor, the margins also depend on prices, and you have seen that last 2 years prices are fluctuating. Fluctuations throughout the year are driven by China factors, also driven by certain environmental factors, demands and trade policies also changing. So it all depends on what price levels we are able to fetch, what market levels are sustaining and changing in 2020. So combining all these factors, our conservative target is to maintain profitability and increase and improve our growth. And that is where the focus is. But if we get a chance, if price fluctuations are positive throughout the year, we might get better numbers than projected at the end of the year.